Hello and welcome to this IFRS, IAS and interpretations update with me, Peter Thatcher. Now, for those of you involved in IFRS and financial reporting, you'll appreciate that every year we get changes to the financial reporting requirements, changes issued by the IASB or even the interpretations committee. And when you look at those changes, sometimes they're very significant. Sometimes they're much less so, in some cases even irrelevant, depending on your particular requirements. And I think it's important that as auditors or preparers, whichever you happen to be, that you always keep ahead of the game and are ready for those changes as and when they come into effect. And I think I'd emphasize keeping ahead of the game. So that you have the opportunity not only to assess the impact of these changes, but also, very importantly, to consider communicating the impact, whether you're communicating it internally to management or perhaps externally to lenders and so on who will be affected by the financial reporting changes. And as part of that communication, I just want to re-emphasize the point that we have to remember about IAS 8. Which requires us to disclose in the financial statements the potential impact of standards and interpretations which are in issue at the reporting date but not yet effective. So for those of you with December reporting dates in your 31st December 2018 accounts, you need to consider reporting the potential effects of all these new requirements coming in, whether it's in 2019, 2021, or even 22. The reason I emphasize that is because I think we have a variable quality of that sort of reporting in terms of how much information is given about the potential impact. And even sometimes people are saying, companies are saying right up to effective date that they're still considering the impact. And arguably, that's not adequate, that we need to get ahead of the game. We need to give a real indication. And even in some cases, if there is no material impact, is to actually state that and be very clear. So what we're going to do in this next hour is to look at the new standards, the amendments to standards and interpretations that will become effective in 2019 and beyond. Now, just look at 2019 and beyond, assuming therefore that you're ready for 2018. So we're looking at the really new stuff. We'll also be looking at particularly at an overview of the key differences between the very important standard IFRS 16 on leases and the previous guidance. Now, we're focusing in this webinar on the key differences and just an overview of those differences. Last year, there was a webinar on IFRS 16. In fact, later on this year, there's another webinar on IFRS 16, which will look at things in more detail. But we just want to flag up the important issues as we go through. And then the final topic we'll look at is the new conceptual framework. Much of the conceptual framework doesn't impact directly on preparers, but there are some very important issues in there that preparers need to be aware of, and a few points of interest within there as well. Now, given we only have an hour, then as you'll see from that list of what's on the agenda, in each case we can only do an overview. So just highlighting the key points, and for some of those, as I mentioned before, you'll identify the issues as being not relevant to you or to your clients. In other cases, you'll realize you need to look at things in a little bit more detail. So we're just trying to flag up where the issues are, what's out there, and then it really will be over to you to then go and explore the detail in those specific standards where that's necessary. As always, as we go through, if you do have any questions at any time, please do send them in via your consoles, and I'll try to answer as many as I possibly can as we go through. So let's do this in a very simple chronological order, starting off with what's new for 2019. So looking at what's effective for periods commencing on or after 1st of January 2019. So we're going to look at 5 sort of fairly minor type issues that have a limited relevance. Of course, IFRS 16 comes into effect in 2019 as well, which we'll come on to later. But looking at the ones which are perhaps less important for many, first of all, we have an interpretation, IFRS 23, which deals with uncertainty over income tax treatments. And the background to this is that IAS 12, the income tax standard, doesn't deal with uncertainty, doesn't deal with the accounting implications of uncertainty. Now, uncertainty in this context means that we're not sure how the tax authorities will respond to a particular tax treatment. And so what IFRS 23 says in summary is that entities have to consider whether or not it's probable that a tax authority will in fact accept an uncertain tax treatment. And the focus on probability is the normal concept of probability. Is it more likely than not that a tax authority will accept an uncertain tax treatment? And what the interpretation concludes is that if it is probable that a tax treatment will be accepted by the tax authorities, if that's what you believe, then everything in the financial statements, whether it be the computation of tax on profits, whether it be deferred tax, whether it be carry forward of tax losses, whatever it may be, is based on the filings that have been made, that tax treatment that you put forward. If, however, you conclude that it's not probable that the tax treatment will be accepted, then you don't use what you filed. What you use instead is either the most likely amount or the expected value. You know, basically what we're crying is you use the most likely outcome in the financial reporting requirements. So it's sort of fairly logical in terms of what you do. It's based on the most likely outcome, and you follow that through. So the second issue, again, has a fairly limited application because it's essentially to do with lenders, and it's dealing with an issue in IFRS 9 with regards to whether we are able to use amortized cost or whether we have to measure these instruments at fair value through profit or loss. Now, what it means by prepayment features with negative compensation, just a little bit of introduction there, it's where you have a lender making a loan and there's the option available for early settlement, whereby that would actually lead to the lender receiving less than the outstanding amount for principal and interest. And that's the negative compensation, the fact they've received less than is actually due. Now, because of the prepayment features, what that could mean is that it fails the cash flow test in IFRS 9 and therefore would take us to having to use fair value through profit or loss. So basically what this amendment is doing is clarifying the point, as with positive compensation for a prepayment feature, that you can potentially continue measuring these loans at amortized cost. The issue really surrounds the compensation. And as with positive compensation, it essentially is the compensation reasonable for early settlement. And if it is, then you can continue using amortized cost. Otherwise, you would have to resort to fair value through profit or loss. So that's that one. The next one, amendments to IAS 28 to do with long-term interest in associates and joint ventures. And it's very much here about the link with IFRS 9 again. So the first issue is a scope issue, just clarifying that IFRS 9 excludes from its scope interest to which the equity method of accounting applies. But IFRS 9 only excludes from its scope where the equity method has been used. It may well be that you have other long-term interests in associates or joint ventures. So for example, you might have long-term loans or preference shares in associates and joint ventures. And if that's the case, IFRS 9 still applies to those long-term interests. So it doesn't apply where equity method of accounting is used, it does apply to these other long-term interests. And then it goes on to clarify that that being the case, that IFRS 9 should be applied to accounting for those long-term loans and preference shares before the requirements of IAS 28. And where that becomes relevant is perhaps that where you've got a situation with an investment in an associate, let's say, the associate is loss-making. And so the consequence of the associate making losses, it's reducing the equity value of that investment over time. So essentially you're debiting the equity valuation over time. And what IAS 28 says is that when you've taken the equity value down to zero, you can't keep debiting with future losses. But what IAS 28 does say is that if you have other long-term interests, then you start debiting those. So you take the equity value down to zero, and then you continue debiting other long-term interests. What this amendment is clarifying is that before you start doing that, you must apply IFRS 9 to these loans and so on. So you must do normal amortized cost accounting, you must do impairments and so on. And only after you've done that would you consider applying IAS 28 requirements. The next one I want to refer to is annual improvements, and literally they are annual improvements, typically towards the back end of each year. So towards the back end of 2018, these improvements were issued, just fine-tuning IFRS where necessary. Often they're clarification issues of things that really we should be doing and just making the point. Just 4 improvements that are included in this standard. The first one is an improvement to IFRS 3 on business combinations, dealing with a situation that if you have a party to a joint operation that is a business, and that you then obtain control of that joint operation, so it then becomes a subsidiary, that transaction is treated as a business combination achieved in stages, and therefore you've got a remeasurement to take place. And that sort of makes sense, that you have indeed built up controlling influence in stages. That's clarifying that point. They are contrasting that by the improvement to IFRS 11, which says that when a party that's only a participator in a joint operation later obtains joint control, then you don't remeasure any previously held interest, because you haven't changed the boundaries of the group, because you're just in a joint arrangement situation. So it's just being clear on those changes, that making sure we differentiate between where we obtain control or where we obtain joint control. The income tax improvement is just clarifying that the income tax consequences of dividends are recognised in the same component of total comprehensive income or equity as the originating transaction or event. So basically, the tax on the dividends follows where the distributable profits are. And finally, the amendment to IAS 23, where we have a qualifying asset, we've been capitalising the interest on that qualifying asset. When it's ready for its intended use, we stop capitalising the interest on that borrowing. And so what it's clarifying, therefore, any outstanding borrowing is then included in the entity's general borrowings when we're calculating capitalisation rates and so on. So those are the 4. There's really not much to add to what is written on those slides. And the final of these minor amendments effective in 2019 is amendments to IAS 19 to do with defined benefit schemes. So if you haven't got a defined benefit scheme, this is an example where you can ignore this. So there's a couple of amendments to it, but the main issue in here is that when you remeasure defined benefit liability or asset following a plan amendment, curtailment or settlement, then the current service cost and net interest, i.e. the impact on profit or loss, is determined using the same updated actuarial assumptions used for remeasurement. And it's just clarifying what one would hope is fairly logical, that you're going to use consistency with regards to remeasuring the assets and liability and for recognising costs through profit or loss. So those are the 5 changes effective in 2019, other than, of course, the changes we'll come on to with regards to IFRS 16. So we can move on a year to 2020, and a couple of, I think, really interesting changes here, one of which I think has massive impact, or could potentially have massive impact on both preparers and auditors. But the first interesting one to highlight is amendment to IFRS 3 with regards to the definition of a business. This issue is all focused on when a company, one entity acquires another, and making sure that we clearly differentiate between, have we acquired a business or have we acquired simply an asset that is actually held within a business. And so amending that definition of a business is hopefully going to clarify that point. And there's some important guidance which goes with that. And the significance is, of course, if you decide that it is a business that has been acquired and it's a business combination, then you've got goodwill impact, you've got fair value adjustments and so on, goodwill, or negative goodwill as the case may be, which you wouldn't have if you conclude that it is indeed an asset that you've acquired, a simple asset acquisition. So on that slide, I differentiate between the current definition and what the revised definition is going to look at. And as you can see from that slide, it's the words that the current definition in red and the revised definition in blue, where the changes are. And the changes are focused on the revised definition saying that it's a business if the purpose is providing goods or services to customers. Whereas the old definition, or current definition, refers to the purpose providing a return in the form of dividends. So I think the focus on, are we providing goods or services to customers, which is going to generate a return, that's, I think, going to be clearer and more helpful for us to decide whether or not it's a business. So I think there's a clarity issue here, which I think will be helpful. But I think what is particularly helpful is they've introduced something new here, which is called a concentration test, and it's an option. It's an option that you make on a transaction by transaction basis, and it's a way of just simplifying the assessment. And so as you can see there, that the concentration test is met if substantially all of the fair value of the gross assets acquired is concentrated in a single identifiable asset or a group of similar identifiable assets. So a single identifiable asset might be an individual property, something like that, or a group of similar identifiable assets might be a specific class of tangible assets, maybe. Now, what there is within this amendment is there is quite a lot of guidance on identifying what could be classed as similar identifiable assets and what couldn't be, to make sure that we're not grouping things inappropriately together. But the benefit of this is if that concentration test is met, so if substantially all of the fair value of the gross assets acquired is concentrated in a single asset, then it's not a business and we don't need to do anything else. Now, there is a degree of judgment in there, of course, because it is substantially all, that's where the judgment comes in. But a few years ago, I had a client, they were a property business, and they wanted to buy another business which had essentially a single asset, a single investment property in his balance sheet. And at the time, we tried to apply IFRS 3, and we're trying to decide whether or not it was a business and goodwill consequences, or whether in fact we were simply acquiring an asset. And had this concentration test been available at the time, it would have been quite a simple conclusion that it wasn't a business because the concentration test would in fact have been met. So I think it's a valuable source of guidance in certain situations. So that's the amendment to IFRS 3 to be aware of. This is the one that I think is highly significant to us, that the definition of material is changing. So the definition of material, which will be both in IAS 1 and IAS 8, but applied, of course, across the board, is actually going to change in 2020. So what they've done is they've changed the definition and they've changed some of the guidance behind it. Now, those of you who've been involved in financial reporting, international financial reporting for a while, will recall this has been a little bit of a theme for the International Accounting Standards Board for quite a while now. So if you can go back to, for example, for periods commencing 1st of January 2016, there were some amendments to IAS 1. And those amendments were trying to stress the point that we should be applying materiality to disclosures. We shouldn't be going down a checklist approach and disclosing everything that standards list. We should be applying materiality. We should only be disclosing information which is deemed to be relevant. The idea was to reduce disclosures to make it more appropriate in some cases. I don't think as a worldwide profession we really grasped that as well as we might have done. So that was in 2016 changes. In 2017, we had the practice statement, making materiality judgments, which again was trying to reinforce that concept of how you decide whether something is or is not material. And then we have a new conceptual framework, and in the conceptual framework we have again a new definition of material, and this definition is therefore consistent with the conceptual framework. So what is the difference? So the definition that we've been familiar with for so long on the left-hand side of that slide is omissions or misstatements of items or material if they could, individually or collectively, influence the economic decisions that users make on the basis of the financial statements. And on the right-hand side, you've got the revised definition, and I've highlighted in red the 3 substantive changes to that definition. So the word obscuring has been added. We now think about what could reasonably be expected to influence decisions, and we're referring now to the primary users. I'm going to come on to obscuring in a minute, but in the old or current definition, an item is material if they could influence. The ISB have sort of reflected on that and decided, well, anything could influence decisions. So therefore, they've adopted what you might class as being a higher threshold. That could it reasonably be expected to influence? So you've got to think a little bit harder about what the user's needs are in terms of what therefore might reasonably be expected in the circumstances to influence them. And the other change there is the old current definition, refers to users, which is a massive range of people potentially. The revised definition refers to primary users. It's a much more limited field. And in some cases, it may, of course, be possible that what you can do is actually go to the primary users and say, what information is relevant to you? And that essentially determines materiality. So again, it should reduce the number of items that we class as material because we're only focused on primary users and we're only looking at items which could reasonably be expected to influence their decisions rather than anything could. But also want to refer to this word obscuring. And in the guidance that accompanies the revised definition, they give some examples of what might be deemed to be obscuring information. And those are the 5 examples that they give. So the first one is, it could be classed as being obscuring information if the language being used is vague or unclear. Now, bear in mind the conceptual framework states that understandability is a key characteristic, it's a supporting characteristic of quality financial information. So if the language we use is vague or unclear, then you could say that's a form of obscuring, and therefore that means it's a material issue. But I think you could also factor into that sort of overall inappropriate use of technical language. Again, it's not understandable. So auditors, preparers need to reflect on the way that we're expressing information in the financial statements and maybe becoming less technical. I think very importantly, the second one is information regarding material item, transaction, or other event is scattered throughout the financial statements. It's interesting when you reflect on financial statements is the way that we often see them presented, and actually you have information in a number about a particular type of transaction is literally scattered. So prior to IFRS 16, you think about leases or operating leases and finance leases. So for example, you'd have an accounting policy at one place, then a bit later on you'd have what's the impact on profit or loss with operating lease rentals. Then a little bit later on in the Property, plant and equipment note, you might have an indication of the carrying value of assets held under finance leases. And a bit further on, you'd have commitments under operating leases. And somewhere else, you'll have the obligations for finance lease commitments. So you've actually got information about leases scattered throughout. So if somebody wants to know what's the issue with regards to leases, it's more difficult to focus. So actually this is almost saying, well, shouldn't we be thinking about putting all this information together in one place? So all the information about leases or property, plant and equipment or financial instruments is all together. And it's interesting, I think over the last few years, we've seen more and more companies adopting that as an approach where the accounting policy is linked with the other information in one place. So scattering could be deemed to be a form of obscuring and therefore a potential material issue. The next two items refer to aggregation or disaggregation and where we've done that inappropriately. So we've put too many items together to hide information, or we've disaggregated similar items and that just puts too much information to be able to see what's really going on. And then the final one, again referring specifically to understandability. Important information is hidden by immaterial information, by a plethora of over disclosure, so you can't find out what's really important. So as we move forward into applying this new definition and guidance, it's again challenging preparers and auditors to focus on what is really relevant, giving people what they really need to help them make those decisions, and to make sure that what we're providing is clear and easily accessible. So I think it's again a significant development if we apply it correctly. So that's 2020, those are the two changes in 2020. So we can now move on to 2021. And we just have the one change at the moment that we know about, which is the long-awaited standard on insurance contracts, IFRS 17. 20 years plus in the making of this discussion paper goes back to 2007. So IFRS 17 replaces IFRS 4. It's a very complex standard, and I tend just to do a very, very high level couple of points really with regards to this, because there's a lot more that you would need to cover if you are indeed an insurance business. Basically, the key point is that this new standard introduces a general model which is applicable for all insurance contracts, and it's not for insurers, it's anybody who writes insurance contracts. Well, it says that, and then it goes on to say that there's actually a simplified model which is called the premium allocation approach, which is available for contracts with a coverage period of 1 year or less. Now that simplified model is very similar to what we do now for general insurers, where we use the unearned premium approach. So there may well be few changes for simple general insurers, but we just need to be conscious of that. The big changes of this standard will come in for life assurance business, long-term insurance business. But everyone's got to think about it if you are involved in writing insurance contracts. Now the scope of the standard is very similar to IFRS 4. The definition of an insurance contract is very similar to IFRS 4, but everybody needs to be going through and checking whether they are in scope and whether they meet the definition. The contracts they're writing meet the definition. So perhaps things like warranty contracts, financial guarantee contracts, for example. So it's a big standard to look at. I just wanted to highlight that it's coming in, but also wanted to highlight actually there's been some more recent changes, because as recently as December of last year, the ISB have decided that they are going to propose some amendments to IFRS 17, and there's a public consultation process they're going to go through, and as a result of that process they are going to propose a 1-year deferral of IFRS 17, in fact to 2022. So it'll give another year for people to get ready as they go through just making some changes before implementation. So those are the various different changes that have taken place. I say some of them will be of greater or lesser impact to you. IFRS 16 is a massively important standard for many, many companies. And as I said at the start, just want to focus on some of the key changes to current requirements at the moment, but re-emphasising, as I mentioned before, it is effective for periods commencing on or after 1st of January 2019 as of now. Reminding you the transition principle, which I think most companies are going to take on board, is that you don't need to restate comparatives. So you can do it from 2019 and not adjust 2018 financial statements at all. So first thing to perhaps reflect on as a difference, the definition of a lease. So IFRS 16 has changed the definition of a lease to that. It's a contract which is or contains a lease if the contract conveys the right to control the use of an identified asset for a period of time in exchange for consideration. And the issue here essentially is the focus on control. And control exists if the customer has the right to obtain substantially all of the benefits from using the asset. Now, clearly that's a different definition to IAS 17. What we have to reflect on is, will it change what in fact seems to be classified as a lease? The general view is it probably won't change too many in practical terms. What we will have to do, however, is potentially provide more evidence to justify whether something is or is not a lease. And that will be a conversation between preparers and auditors in terms of what level of evidence is going to be required. But it shouldn't lead to too many fundamental changes. Important transition point is that at transition date, at the 1st of January 2019, the date of initial application, you don't have to reassess contracts in existence at that date. So if you have leases in existence at date of initial application, you continue treating them as leases. And if they weren't leases at that date, then you don't need to treat them as leases. So this new definition only has to be applied from the date of initial application, for example, the 1st of January 2019. What IFRS 16 does, however, is give far more focus on the difference between a contract for service and a lease. Because leases are going to come on balance sheet, then it's important to identify a contract for service separately to that, because a contract for services remains off balance sheet, and so we simply expense that as incurred. So there's a bit more focus on that, and there's also new guidance with regards to when we have a contract with some lease and non-lease components. So for example, vehicle leases with maintenance services, building leases with cleaning and security services. Now, in many cases, it will be obvious from invoices what the rental element is and what the service element is, in which case we should treat them separately. If it's not obvious from the way that we are invoiced, then as it says, we must split them. This is effectively applying an IFRS 15 principle of performance obligations, if you like. So we must account for the lease element separately, which is normally going to be on balance sheet, and the service element, which is normally just going to be expensed. There is a practical expedient here that if you can't do that split in any meaningful way, then you can elect to account for the whole contract as a lease. The consequence is, of course, that you're going to have a bigger asset and a bigger liability because more payments are going to be classed as a lease. Now, the focus, as always with change in IFRS 16, is on lessee accounting, because lessor accounting has remained largely unchanged. So the first thing is just to highlight these couple of exemptions. So the general principle, which hopefully you're very familiar with, is that IFRS 16 is abolishing the distinction between operating and finance leases for lessees, and instead these leases will come on balance sheet as a right of use asset and a lease liability. Of course, for lessors, they still have to consider operating and finance leases and still follow the accounting for those. So for a lessee, it's much simpler because we don't need to go through, is it an operating lease, is it a finance lease, and worry about the consequences. However, we have these two exemptions, and they are pragmatic exemptions that IFRS 16 has included. They're optional exemptions for short-term leases and leases of low value assets. So if you take these exemptions, we don't put these leases on balance sheet. Instead, we recognize the lease payment as an expense over the lease term. So effectively, we're doing operating lease accounting. A short-term lease is one which has a term of 12 months or less at commencement date. We focus on the definition of lease term, which I'll come on to in a few minutes, but if it has a lease term of 12 months or less, then that's a short-term lease, and therefore we can elect for them to be not brought on balance sheet. But this exemption is made or taken by class of underlying asset. And there's appropriate disclosure when you've taken that exemption. The other exemption, and of course all of this is new, is for leases of low value assets. This exemption is available on a lease by lease basis. And it's just, again, pragmatic to do that. So we don't have to capitalize fairly trivial items, if you like. Now, what is a low value asset? Well, it's not defined as such, it's described in Appendix B. So a few important points that are highlighted in Appendix B. It's based on the value of the underlying asset when new, which may be different to the value of the asset when the lease commences. Importantly, the assessment is made on an absolute basis. It's not a relative measure, it's not the same as materiality. So it doesn't matter what size of organization it actually is. So the advice always is every entity needs to have their internal criteria about what they are going to classify as a low value asset. Now, in the basis for conclusions, but only in the basis for conclusions, not in the standard itself, the International Accounting Standards Board will refer to $5,000 as possibly being an indication of what they're thinking about. But that's something for you to decide. What value do you believe a low value asset is? And that, of course, will need to be agreed with the auditors in advance. And a couple of other criteria about benefiting from use, which is fairly straightforward to adhere to. And the other point there, the underlying asset is not highly dependent on or highly interrelated with other assets. So it's to avoid trying to create mini leases which actually form one single asset. It's an anti-avoidance measure, if you like. And if you sublease an asset, then again, that takes you out of the possibility of using the low value asset exemption. So a lot of things to think about there, I think, to make sure that you're applying it appropriately, but it's an important exemption which might benefit you from a lot of time and cost. So moving on to the recognition and measurement requirements of IFRS 16. We're using the right of use model, which in principle fixes familiar. So the lessee recognises a right of use asset and also recognises a liability for the obligation to pay rentals. We subsequently depreciate the asset and recognise a finance cost on the liability, and we reduce the obligation, the liability, as we pay rentals. Sort of familiar, but there's some differences in the detail. So first of all, when we measure the liability, IFRS 16 says that we measure the liability using the present value of lease payments not paid at that date, discounting those payments using the interest rate implicit in the lease. If that rate can't be readily determined, we use the lessee's incremental borrowing rate. IAS 17 slightly different because the amount we recognise both as a liability and the asset is the lower of the present value of minimum lease payments and the fair value of the leased asset. So IFRS 16 doesn't have the fair value option for the valuation. We just use present value of minimum lease payments. But in both cases, we'd be using the implicit rate of interest or the incremental borrowing rate, as the case may be. When we move on to the asset, then under IFRS 17, it's the amount recognised as the liability plus direct costs. Whereas under IFRS 16, we've got a number of extra components. So it's the amount of the liability plus any payments made before commencement date, less any lease incentives, that's obviously brought in this one place, direct costs, and the dismantling or removing provisions similar to the one we apply for property, plant and equipment. So we've got to remember when we recognise these assets moving forward that we've actually got to include all of these components, and it's different, subtly different to IAS 17. So you tend to get a larger value on your asset, and it is more likely to be different from the figure for the liability because of these other components. Now, because we're going to be capitalizing the present value of lease payments and recognizing that as the liability, then we look at the definition of lease payments. And again, you can see that there's a difference. So looking at the IFRS 16 definition, then we include all of these different components. So fixed payments, like the annual rental of £10,000 a year, lease incentives receivable. We include variable lease payments, provided that they depend on an index or a rate. So they might be linked to the market rate index for similar properties or assets, or they might be linked to the consumer price index. If they're not linked to an index or a rate, then you don't include them. They just get recognized as we go through. We must also include any in substance fixed payments, is what we call them, which is where something in name is variable, but in practical terms is unavoidable. That should also be included as one of the lease payments. And then we've got residual value guarantees, purchase option prices, and any termination penalties. So all of those components need to be included. So again, you'd expect, if you do a direct comparison, that the IFRS 16 payments will probably be higher than those that you would have included under IAS 17. In terms of the lease term, so of course we're capitalizing the payments over the lease term. That's the definition. It's the time period over which you have the right to use the asset, but also including periods covered by extension options or periods covered by options to terminate leases. We include periods covered by these options if they are reasonably certain to be exercised. And that reasonably certain language was used in IAS 17. The definition looks very familiar, very similar here. I think where the difference comes is the guidance behind reasonably certain. So what IFRS 16 is saying, that you must take into account all facts and circumstances that would cause the entity to act. So if, for example, there is an option to extend, then you have to consider how likely are we to extend by taking into account things like what would be the implications on future rentals, what would be the implications on costs of moving, what would be the implications on the fact we've incurred costs to improve the leasehold property. So you're being very pragmatic and therefore saying that you might have an option in 5 years, and actually saying, well, realistically, we are going to extend because it wouldn't be worthwhile to move at that point. So therefore you would take that option to extend into your lease term. So it may well be that we would end up with longer lease terms under IFRS 16 than we might have done under IAS 17. But again, it's judgment, it's things that need to be discussed and agreed with the auditors as you go through. Thereafter, it's very similar to now. The right of use asset is measured at cost less accumulated depreciation and impairment losses, and the lease liability increase the carry amount by the interest as you unwind the discount, and reduce it by the lease payments, and bring in any changes if there's any reassessment or modifications on the way through. In terms of presentation, sort of familiar with similar to what we're used to. So the statements of profit and loss or the comprehensive income, we have the unwinding of the discount as a finance cost, the depreciation of the asset, and we have any variable lease payments that weren't included in the original lease liability measurement. So these are recognized as an expense. We highlight those. In terms of the balance sheet, we could show the right of use asset and liability separately on the face of the balance sheet, or we could include them with the appropriate line of similar assets and liabilities, and then sub-analyze that in the notes. Again, decisions about what is going to give the most relevant information to your users. And then in the cash flow sense, of course, we haven't got operating leases anymore, so the lease payments need to be split between principal and finance costs, as we should currently do for finance leases. However, of course, we've now got short-term lease payments and payments for leases of low-value assets, which, if expensed, should be included within operating activities. And finally, just want to highlight couple of things on disclosures. As you might expect with any new standard, the disclosures are more than they currently are. But I just want to highlight the fact there is a disclosure objective, and this is the focus of what you should disclose, and it's part of this materiality concept. Only disclose information which is material, but make sure that we do disclose information which is material. And so the purpose behind the disclosures is to ensure that the information that we provide, as it says there, gives a basis for users of financial statements to assess the effect that leases have on the financial position, the financial performance and cash flows of the lessee. That's the standard that we must measure all of our disclosures by. Is it helping the users to make that assessment? In terms of presentation, the standard says you can either disclose this information in a single note or in a separate section with a number of notes. But if information is elsewhere, you don't need to duplicate it for the sake of it, but you perhaps need to think about pulling all of these disclosures together just to make it easier to understand and read. Now, the detailed disclosures are set out in those few paragraphs 53 to 60 of the standard. They're fairly straightforward. In most cases, it's things like disclose the depreciation expense, the expenses in relation to short-term leases and so on, to disclose the additions to right-of-use assets, to disclose the carrying value by class of asset. So very straightforward just to work through those disclosures. But I just wanted to highlight paragraph 59, because paragraph 59 goes back to that disclosure objective, and it's an additional general requirement. It's re-emphasizing what we must make sure we're doing. So first of all, it says that in addition to the specific disclosures that are required, lessees should disclose additional qualitative and quantitative, numeric and narrative information about their lease activities in order to meet the overall disclosure objective that was referred to earlier. So it's an override principle to make sure that we focus on the disclosure objective. And they suggest that that additional information may include this information. Now, this is presented in a principle basis, so it's not a list of things. It's saying if it helps users to understand the nature of the activities, that might be helpful. To understand information about cash outflows in relation to variable lease payments or options or residual value guarantees. Any issues with regards to restrictions or covenants imposed by leases, or any sale and leaseback transactions. So these are things that you've got to think about and then decide how much and what information you need to disclose as well. But it's that focus on the objective is paramount, that we must meet that requirement. So that's the key issues brought in by IFRS 16. So the differences. It's a standard which has massive impacts for many, many companies, and hopefully you're really starting to get into the swing of what's required and start to think about the impact of that. The final topic that I want to cover is just a brief run through the conceptual framework, highlighting some of the points that might affect you as preparers or auditors, as the case may be. Now, the background is the conceptual framework has been around since 1989. In 2005, a joint project between the Americans and the International Accounting Standards Board began to revise it. In 2010, 2 new chapters were issued jointly between the American and the International Accounting Standard Board. But then it sort of project stalled. But in 2011, as part of the agenda consultation of the IASB, it decided that this should be a priority. So the International Accounting Standards Board decided to pursue this project on its own. So this is the International Accounting Standards Board new conceptual framework. It's not the joint project anymore. So it's published in March. It's effective immediately for the International Accounting Standards Board as they develop new standards and for the interpretations, and they amend standards, case may be. For preparers and therefore auditors, it's effective for periods commencing on or after 1st of January 2020, where an accounting policy is affected by the framework, where you've got to develop your own accounting policy and using judgments and definitions. The purpose is sort of well understood, I think. Essentially, it's for the board, the IASB, to develop IFRS based on core set of principles, if you like. For preparers, it's about developing consistent policies when no IFRS applies, or, importantly, or an IFRS allows a choice of policy to make sure you're making the right choices to accord with the framework. And it may also assist users of financial statements to understand and interpret them. There are 8 chapters in the new conceptual framework. Brief overview of them. Chapter 1 is the objective of financial reporting. This has remained largely unchanged since 2010. Sort of the only thing they've really emphasized new in this is that they re-emphasize the importance of stewardship. So one of the objectives is to make sure that users can assess whether management have in fact been good stewards of the company and can hold them accountable to the way they've run the business. Chapter 2 is again largely unchanged because again it was extensively revised in 2010 as part of that joint project with the Americans. Importantly, however, they've enhanced the guidance, the emphasis on substance over form. That remains a core issue, and highlighting, emphasizing the fact that if substance over form and legal form are different, then we need to make sure both are reflected if the financial statements are to give faithful representation. So substance over form has been enhanced as a concept, and prudence comes back. Prudence hasn't really been around for a while as a principle. They brought it back and saying that we must exercise prudence, so not overstating assets and not understating liabilities, but we should exercise prudence with caution. So equally, we're not going the other way, and we're not deliberately overstating liabilities and understating assets for a particular purpose. So there's a new paragraph on prudence has been included. Chapter 3 is very much for the IASB when they develop standards, so objective and scope of financial statements and a description of the reporting entity. So the reporting entity may not be a legal entity. And they introduce a couple of new ideas. So we not only have consolidated financial statements, they also now refer to unconsolidated and even combined financial statements as well. Chapter 4, the elements of financial statements. Well, we're familiar with the 5 elements of assets, liabilities, equity, income, and expenses. One of the key points I wanted to highlight is they have refined the definitions of assets and liabilities, and that might have an impact. So the definitions of an asset, what we're familiar with, it's a resource controlled by the entity as a result of past events and from which future economic benefits are expected to flow. The revised definition of an asset is present economic resource controlled by the entity as a result of past events, very similar. But they now define an economic resource. An economic resource is a right that has the potential to produce economic benefit. So the current definition, previous definition, refers to where economic benefits are expected to flow. The new definition refers to they simply have to have the potential to produce. And that might therefore mean we operate at a lower threshold. And then in terms of the definition of a liability, the key change is the new definition specifically highlights what we mean by an obligation. An obligation is a duty or responsibility that the entity has no practical ability to avoid. So it may be those things will factor into whether we need to recognise assets or liabilities. We need to take care of that as we move forward. In terms of recognition and derecognition, they've revised the criteria. So rather than, for example, with an asset, that we would recognise an asset when there are probable economic benefits to be received and we can measure them reliably, we won't use those criteria anymore. That we will recognise an asset when it meets the criteria, the fundamental characteristics of providing relevant information which can be faithfully represented. So relevance and faithful representation will dictate whether we recognise assets and liabilities. They've included some new guidance on derecognition. So when we remove assets and liabilities, broadly it's when we fail to meet the definition, which means that for an asset it's when we lose control, and for a liability it's when we no longer have an obligation. Chapter 6 on measurement. All the sort of classic measurement bases are still there, of fair value, value in use, historic cost, and so on. They've just refined the guidance a little bit so that when we're selecting a measurement basis, when the ISB is dictating a measurement basis, that they are actually being clear about which one is the most appropriate to use. Chapter 7 is a new chapter on presentation and disclosure, very much for the ISB, but what we'll see coming through in particular is this emphasis on gains and losses being reflected in profit or loss and only exceptionally being included in other comprehensive income. So the statement of profit or loss will be the key statement for recognizing gains and losses. And chapter 8, the concepts of capital and capital maintenance. And this is unchanged from 2010. That framework, in fact, is unchanged from the original 1989 framework. So those are just an overview of what the changes are. I think one of the key issues there is the definition of assets and liabilities, and the principles of prudence and substance over form being part of this framework, maybe things that we need to reflect on as we move forward. Be aware there's also some consequential amendments to IFRS. These are changes to standards and interpretations which refer to the conceptual framework. So quite a number of these have been changed, and these amendments become effective for periods commencing on or after the 1st of January 2020. Just before we finish, I've got a couple of questions here. First of all, do we need to consider the lease changes for a 31st December 2018 year end? Simple answer to that would be no, unless in due course you want to change your comparatives. So one of the transition options available to you is only to apply for your current financial year, which will be your first accounting period beginning on or after the 1st of January 2019. So no, you wouldn't need to go back and restate 2018 at all. Do the lease changes need to be assessed on historic leases, resulting in a possible prior year adjustment, or only on future leases? Yes, they do, because let's assume we have a December year end, and therefore you are only going to be applying the new standard from 1st of January 2019. You will need to consider adjustments to the values of leases at that date, and that will essentially be around the fact that you will be bringing leases previously classified as operating leases will be coming on balance sheet. So that's where you'll be doing your prior year adjustment at that point, is bringing operating leases on balance sheet. It might be more than that, depending on the transition adjustments that you actually take, but yes, there will be prior year adjustments, so you need to start being ready for that, of course, for 1st of January 2019, or whatever your date of initial application is. So I hope that's answered those two questions, and thank you for that. But that aside, with no other questions coming through at this point, as I said, the whole purpose of that was to give you an overview of all the changes, of which there are many to reflect upon. And I hope that's given you an indication of the sort of things that you might need to take account of, and again started to get you thinking about the leases changes in particular. I would emphasize as well, I think the changes to the definition of materiality are also pretty important as well. So as you do that, don't forget the IAS 8 requirements to disclose the possible impact on your financial statements in future periods as well. So on that note, thank you very much indeed for listening.